No matter what the courts decide, the economic consequences are going to be severe. I'll show you why what happened on Friday changes everything. Now let's turn to Bloomberg, where we picked today's story up as Trump's global tariffs have now been found illegal by a U.S. appeals court. And of course, what this is going to set up is all of this is going to end up going to the Supreme Court. But until that happens, it's going to create a tremendous amount of uncertainty because at the consumer level, everyone's bought into the fact that we're going to see tariffs and likely prices are going to go higher. But now it could get reversed. And for a lot of businesses have been absorbing all these tariffs, well, things are going to change for them as well. So what we could see is a big drop in production here as everybody goes on hold. But what about our trading partners? Well, that could get escalated as well. People could start ignoring the tariffs, and even those in the middle of a negotiation may just walk away. And what this is going to do is create all-out panic. The statute bestows significant authority on the president to undertake a number of actions in response to a declared national emergency, but none of these actions explicitly include the power to impose tariffs, duties, or the like, or the power to tax. Of course, it doesn't also explicitly exclude them either, and that's going to be the contention here is, does President Trump have the authority? The problem is, if this is revoked, it's going to cause absolute chaos. It's a total disaster, President Trump said. All tariffs are still in effect, and yes, they are at the moment. Today, a highly partisan appeals court incorrectly said that our tariffs should be removed, but they know the United States of America will win in the end. If these tariffs ever went away, it would be a total disaster for the country. And President Trump is right on a number of levels, but economically speaking, no matter what the outcome here is, as you're about to see, the consequences are going to be severe. And trillions of dollars of global trade are embroiled in a legal fight. A final ruling tossing Trump's tariffs would upend as much Bollywood trade deals. The administration would also be forced to contend with demands to refund tariffs that were already paid. And boy, that would be a huge embarrassment to this country. But beside that, the consumer is not going to benefit here because what did we find out from the tariffs is that we're supposed to be paid by many of the foreign countries or companies. And yes, to some degree they were, but a lot of American companies absorbed them. So they got rebate checks back. Just think about it. Are they likely to pass it on to consumers? Absolutely not. And that's the problem here is consumers have absorbed some of this expense, but it's also come at the cost of the bottom line for a lot of companies. Now, we haven't really seen the effects of it, but likely in the third and fourth quarter earnings it's going to show up. But if these rebate checks come back, is it going to be a boom for the labor market? Not at all. It's going to be a huge boom, though, to the stock market. Because when it comes to labor, there's no reason for companies to pass on higher wage increases even if they get rebate checks. Let's take a look at why. Because when you look at average hourly earnings of production and non-supervisory employees in blue against the unemployment rate, you find out one very important thing here, that the demand for labor and the supply of labor is what dictates how much people are willing to pay for labor. And what you can see very clearly going back all the way to the 1990s is that the unemployment rate went up. What happened? Average hourly earnings decelerated. And you see the same effect going into every recession. So what's the problem now? Is there is a supply of workers on the unemployment line, and businesses realize, look, if their employees complain and said, look, I want a bigger raise, well, they can always go out and get someone else. So what this is going to do is going to increase the bottom line for a lot of companies. It's going to send stock prices surging in a major way if this happens. But economically speaking, where the stock market goes, it doesn't mean the real economy follows. And that's going to be the major problem here, is because the outcome of this, regardless of what happens, is going to be severe. The International Emergency Economic Powers Act does not specifically mention tariffs and has never been used in such a manner, and this is why this is going to go all the way to the Supreme Court, because we're going to find out if the president has the authority to do this. And again, it doesn't matter what the outcome is, because the problem we're facing right now is the economy is going down the wrong path. And even if rebate checks come back, again, it's going to be a huge win for the stock market, and companies are going to buy back even more of their shares, but it's not going to get passed down to the average consumer. But there still is a way that you can win regardless of which way the economy goes. Let's take a look at this trade we put back onto our Momentum Timer Pro subscribers on the 7th. We told them to buy ag commodities. That trade is now up 6.5%. 6.68% and going even higher. And over this weekend, we gave an update on our stop loss levels, because one thing that we do that a lot of other programs don't is we give people risk control levels and update them right along the way. Now, we're changing the way people trade with our new Metre strategy. If you haven't heard about this, stay tuned to the end of the show. But in the meantime, if you want to grab trades like this, all you have to do, hit those links in the description below and use a coupon code for your free 30-day trial. Because Treasury Secretary Bessent says, look, if this gets pulled back and we have to give money back, it's going to be a major problem. And this is causing panic all the way at the top echelon of the White House. And fearing the court might rule that tariffs illegal and invalidate them immediately, Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and Secretary of State Marco Rubio all warned of dire foreign policy consequences if the court took such action. And Bessent said it would lead to dangerous diplomatic embarrassment for the U.S., and that is just the beginning of what would happen, because this is a major problem. Because one of the issues here that everybody's fixated on is the deficit. Now, I want you to understand what the trade war was partially meant to do here is offset a lot of these tax cuts by bringing in a new source of revenue from the tariffs. But the problem is, if we have to refund this money and they are deemed illegal, it means the deficits are going to surge here even more. And there's a big problem, because when governments start to take on an excessive amount of debt, well, it has a major impact to long-term trend growth. In fact, what we do know throughout history is growth starts to go down. And that's why I'm saying, regardless of the outcome here, there's way too much debt. And again, if these tariffs are removed, it's going to have major implications. The states and businesses argue that trade deficits are a persistent part of the U.S. economy and therefore not an emergency. And the fentanyl-related tariffs are a dress-up negotiating tactic rather than a legitimate effort to stem the flow of drugs. But the real issue here is, again, the deficits are continuing to rise. The government's taking on more debt. And what I want you to understand here is, in order for the government to pay for all this money that they need, they have to pull it from the private sector. So the bigger the debt gets, the bigger the debt cost gets, the more money they have to pull from the private sector to fund the government. And that means less money for the private sector to grow. And that's the problem here. And this is something we've seen throughout major countries all across the world over different time horizons. The more debt they get, their growth starts to go down. And that is the risk we're facing here. And one of the reasons why I'm saying the economic consequences of what's happening right now are going to be severe. Because one thing people are going to point to and say, well, wait a minute, Steve, real gross domestic product is looking really good. It's a sign that the economy is booming. And can't you see the stock market? It's up right now. It's telling us that the economy is going to boom. But one of the reasons why the GDP rate is where it's at is due to inventory building. And one of the challenges, when we're going to look at the consumer side of this here in a moment, is they don't have the money to buy all of this inventory. And the issue then is what happens after periods of inventory building where there's no demand? Well, GDP comes crashing right down alongside it. And let's take a look at real gross domestic product in blue against continued claims in red. And what do you see? Periods of inventory building lead to a deceleration and even contraction in GDP. At the same time, you see continued claims rising. And you can see that's exactly what's happening now. We got this big boost due to inventory building. We know there is likely signs GDP growth is going to slow. And one of those indicators is the fact that there's nearly 2 million Americans on unemployment, meaning their consumption is going down. We're also kicking people out of the country, which maybe you agree with or don't agree with. But again, in the end of the day, it's fewer consumers lead to less consumption, less demand. And then you've got these inventory overhangs that need to be cleared out. And the problem is that leads to less demand, and it goes all the way up at the factory level and starts to backfeed all throughout the economy. And Secretary Bessent said suspending the effectiveness of the tariffs would expose the United States to the risk of retaliation by other countries based on the perception that the United States lacks the capacity to respond rapidly to retaliation. And that is a major issue here, because all of a sudden you could see a lot of tariffs go up against us. It would have a massive impact on our economy. At the time, we're already seeing it slow down. We're seeing the risk that there's going to be further unemployment. And it's very clear, because when we turn to the University of Michigan Consumer Confidence Survey, that was flagged as one of the biggest concerns right now about consumers. U.S. consumer sentiment declines on dimmer views of economic outlook. And again, it has nothing to do with the trade war specifically, because something I want you to understand is the trajectory of the economy was already going down. That was the issue we were facing here. But due to all this front running of the trade war, it caused this artificial boost in demand, and it gave a lot of people, including the stock market, the perception that we were experiencing a soft landing and the economy was going to boom here. What we did do is pull forward more demand, and what we're facing now is a much bigger cliff, and consumers are seeing this coming in a major way. Let's take a look, because we saw sentiment rally and then roll over. Remember, I said this was a huge risk, because why did it rally in the first place? Likely due to the stock market. Of course, a lot of experts said it had to do with inflation expectations coming down. But you may recall I said, look, inflation expectations were coming down because they were artificially pushed higher by consumer perception here. And remember, one of the issues we faced was, Fed Chair Powell said, we're setting policy based on expectations, which is ridiculous, because I'm going to show you why they're going to come. Crashing down even more. But let's take a look at the report first, because the final August sentiment index fell to 58.2 from 61.7 a month earlier, even lower than the preliminary reading 2 weeks ago at 58.6. So what we're seeing are consumers are less confident about the economy. Yes, they're seeing the stock market go up, but that is nothing to do with what's going on in the real economy, and that is the problem here. Because the figures underscore consumers' anxiety about employment prospects and business conditions. About 63% of consumers expect unemployment to rise in the year ahead, an increase from the prior month and well above the same month in 2024. The August jobs report next week is projected to show employment growth remain moderate for another month, but I think it's going to be underwhelming. I think it's going to show that the economy is continuing to decelerate here. So even if these tariffs are deemed illegal and companies got big rebate checks, again, I wanted you to understand that what they're going to do is they're going to use it to buy their stock back. They're going to use it to pad their bottom line, because the issue here in terms of hiring more people, it's all about demand, and consumers are tapped out in a lot of different ways. So even if prices do come down a little bit, but in reality, they're not going to. What's going to happen is companies will certainly come out with coupons or discounts to clear inventory, but they're not going to significantly lower prices because they don't want to. You know, a lot of these executives, they want to defend their stock price because they know in the coming quarters it's going to be hard to fool investors that things are getting better. And the evidence is clear, because when consumer confidence goes, well, spending is going to fall with it. And that's the biggest risk we're facing here, and why the outcome really doesn't matter, because in the end of the day, it's the U.S. economy comes down to the consumer. And you can see very clearly going back all the way into the 90s, when confidence slows down or declines, as we look at the consumer sentiment survey in blue, what do you see? Advanced retail sales, they go down as well. And you could see that throughout the cycles. As soon as consumers lose confidence, as they did back in 2021, retail sales came crashing down. Now the risk is that they're going to come down again. And the problem is, as we look particularly to small businesses, and you think about why they're fighting this, because they're fighting for their survival. Many of them are now months away from failure. They just don't have the revenue to sustain against all of these higher costs and expenses. There are going to be more layoffs, and this is exactly what consumers are concerned about. Not just the fact that they're going to lose their job, but the fact that they won't be able to find another one. And what that means is spending is going to drop in a big way, as buying conditions for major purchases like durable goods and vehicles both got worse this month. A growing share of consumers mentioned high prices as well as tax tariff considerations as factors on weighing on buying conditions for cars in particular. But the reality is, if you're worried about losing your job, then you're not going to go out and buy things like homes and cars. You're going to buy the things you need now, maybe buy a few extra things, and then you're going to start saving money and paying down on your debt. And the problem is, once consumers lose confidence, particularly in a consumption-based, debt-based economy, it's game over. However, the government data released earlier on Friday showed that consumer spending in July rose by the most in 4 months, boosted by income growth. So was it based on incomes? Was this all about the fact that those who had a job got a pay raise so they went out and spent more? Or is it continued signs that consumers are trying to get ahead of the tariffs? They're trying to front run it every way possible. And that's what I think is really going on here. And based on what we're seeing in the sentiment survey, it's telling us our economy is about to go face first right off a cliff. And looking forward, the University of Sentiment survey showed the expectations index, and this looks out about 6 months from now, dropped to a 3-month low of 55.9, far worse than the preliminary reading at 57.2. The current conditions gauge also fell from a month earlier to 61.7. So what we're seeing now is consumers look forward in the economy, they see things getting worse, and that's going to impact their spending. So as we look backwards and say, wow, their spending actually increased as wages went up, the question is, what's going to happen going forward? We know it's going to get worse, and the reason we know it's going to get worse, because the Fed is starting to panic too. And Fed's daily signals openness to interest rate cut in September. What she's saying now is that there's a balance between inflation and the labor market that's starting to come into play. And the concerns is if we see a continued decline in deflation, it means demand's going to continue to drop. It means then the risk is you lose your labor market. But she's not the only one. We see Fed's Waller is saying quarter point cut in September and then probably more after that, because Waller wasn't worried about inflation. He was one of the few Fed speakers that came out and said, look, I don't think we're going to see inflation from the trade war. And he didn't say why, but it's very obvious, because when prices go up and wages go down, people can't afford higher prices and they can't get passed through to consumers. But what he's really worried about is the labor market coming unglued here. So what you're seeing is more and more Fed speakers are getting in line with a quarter basis point cut. That's why you're likely to see the next Fed meeting, which is about the third week of September. Fed Chair Powell's going to come out and cut 0.25%. He doesn't want to go more than that this time, and you maybe remember why from a previous show. We talked about the banking sector. He wants to keep rates high as long as he can for the banks so they can get rid of those underperforming, those low yield debt, and replace it with higher yielding government debt. He wants them to get rid of those low yielding loans and take out and sell even more higher yielding loans. That's what he's worried about, because there's no margin for error at the banking level. So he needs to extend this as long as possible, not to mention he doesn't want the perception on Wall Street that the Fed is panicking here. He needs the market to go higher, because who are the last consumers that are still spending money? Those that are tied to the stock market. But now what we're facing is if these tariffs are removed, the U.S. consumer spending may not be as resilient because inflation is going to go away. Let's take a look at the PCE index. Came up to 0.2% month over month. The year-over-year rate of change was up 2.6. So we still see acceleration in inflation. At the core level, when you exclude food and energy, it was at 2.9%. So we did see real consumer spending, which is, again, inflation-adjusted rise. But what if we see these tariffs get unwound? You're going to see inflation come completely crashing down. And what is the problem if you're a Fed Reserve board member, or even worse, the chairman at this point? Well, it tells you behind the curve, because you're about to lose the labor market. Let's take a look here, because you see the federal funds rate in blue overlaid against continued claims in red. And you can see as continued claims rise, the Fed should be cutting rates, but this time they didn't do it. And now we're on the cusp of seeing continued claims break over 2 million, and everything is pointing to the Fed being behind the curve here, and that is the major risk going forward. And this is why I said the economic consequences are going to be severe no matter what the outcome is, because it's not so much about the tariffs at this point. It's about the fact that consumers are afraid they're going to lose their job and they can't get another one, so they're going to cut their spending. And that means as they spend less, you're going to see it backfeed all throughout the economy. And that means more people are going to face job losses. They're going to see their hours cut, their spending is going to drop. And next thing you know, everything's going to spiral right out of control. But something that shouldn't be spiraling down if the economy goes with it, that's your trading account. Let's talk about our Momentum Timer Pro report, because this is where we got our DBA trade. Now, how do we do this? Every day we look at those momentum indicators. Now, a lot of people like to trade things like the RSI and the MACD, but they find themselves getting in late and out early, and then they trading all over the place. The problem is they're not doing it right. Now, what we do is we aggregate all these indicators together, and then we run a trend overlay. And when we see everything in confirmation, that shows up on our hot list. Now, every day you get the report. We show you all the momentum signals across the broad equity, bond, currency, commodity markets. We give it to you on a 1 day, 1 month, 3 month, and 6 month window to help you trade momentum more effectively. But in addition to that, not only do we give you the trades, you get my opinion, you get risk control levels, and right now you also get our meta strategy trades. Now, our Metre strategy is an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. It is optimized for swing trading with a target hold period of 2 to 15 days. It has a frequency generating 155 signals per year and a success rate at 55%. Mind you, this is better than any of those individual strategies on their own with fast profit taking. And again, right now at no additional charge, this is included in our momentum timer per report. All you have to do is grab those links in the description below, use a coupon code so you get 30 days for free. So you get the daily report, you get the tradable signals, you get the meta strategy signals, you get risk control levels, a full tracking of all our open trades and returns, a weekly update, and again, the best part of all, you don't even have to put a dime out to try it for your first 30 days. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.